We are covering the Premium Tax Credit, or PTC, and the critical process of reconciling Excess Advance Premium Tax Credit, or APTC, on Form 8962. This is a refundable credit designed to help eligible individuals and families afford health insurance purchased through the health insurance marketplace. The exam will almost never ask you to simply define the credit. Instead, it will test your ability to handle the reconciliation when a taxpayer's circumstances change during the year. The entire process hinges on household income. For PTC purposes, household income is the modified adjusted gross income, or MAGI, of the taxpayer, their spouse if filing jointly, and every dependent in the household who is required to file their own tax return. This is a classic exam trap. A question might list a dependent's income, but if they are not required to file a return, their income is excluded from the household income calculation. Always check for a filing requirement. Eligibility for the credit is based on this household income as a percentage of the federal poverty line, or FPL. At the beginning of the year, a taxpayer estimates their income to the marketplace. Based on that estimate, the marketplace determines an advance premium tax credit amount, the APTC, which is paid directly to their insurance company each month to lower their premiums. The exam scenario always starts here. Let's use an example. A single taxpayer, Sarah, estimates her income will be $35,000. This puts her at approximately 240% of the FPL. Based on this, she is granted an APTC of $250 per month for a total of $3,000 for the year. However, Sarah receives an unexpected promotion in July, and her actual MAGI for the year ends up being $50,000. This is where the reconciliation on Form 8962 comes in, and it's the core of what you'll be tested on. At tax time, Sarah must calculate her actual PTC based on her actual income of $50,000. With this higher income, let's say her allowable PTC is only $1,200. The exam question is, what happens now? Sarah received $3,000 in advance payments but was only truly eligible for $1,200. This means she has an excess APTC of $1,800. But here is the most important exam trap. She doesn't necessarily have to repay the entire $1,800. The law provides repayment limitations based on her final MAGI as a percentage of the FPL. For Sarah, her $50,000 income might put her between 300% and 400% of the FPL. For a single filer in that bracket, the repayment limitation is capped. For example, it might be capped at $1,500. So even though her excess APTC was $1,800, she only has to repay $1,500. The exam will give you the repayment limitation tables or the specific amount and expect you to apply it correctly. Another major testable point is the temporary elimination of the 400% FPL cliff. Before 2021, if a taxpayer's income exceeded 400% of the FPL by even $1, they lost all eligibility and had to repay all APTC they received, subject to the limits. However, for tax years 2021 through 2025, this cliff is removed. Now, if income is over 400% of the FPL, the taxpayer's required contribution is capped at 8.5% of their household income. The exam may try to trick you with an old rule scenario or test you directly on this new 8.5% cap. To remember the core concept, think, reconciliation is key for the PTC. The taxpayer must compare the advance payments they took to the credit they truly earned. If the advance payments taken were too high, a repayment is due. But always remember to check the limitation tables.